Hello everyone, welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of July the 11th, 2016. Now, to start this week's presentation, we're going to begin where we always do, with that all-important US dollar index, but we also want to look at the payroll number that has been released on Friday. 287K, I think, was the number on the jobs. Not too bad, but where we really want to look at this is looking at 2006 is the U6 number. We want this number moving lower. We've basically been moving sideways through all of these months right here. You can see we started off, I believe we started off in January at 9.9. We then went to 9.7, but then back up to 9.8. And then we've basically been flat for April and May at 9.7. But then we've gone to 9.6 on the U6 number. Now, with my own direct clients, I always recommend, to look at the U6 number to get an overall view of the unemployment number. So 9.6 is a good number. That's why we're seeing the unemployment rate down. That's why we're seeing the slightly higher job creation numbers. But again, it's just a better overall number in general, going from, again, starting the year at 9.9, we've gone down to 9.6. While the U3 is more of a household number, a survey number, the U6 does have some meat here to it. So this should be supportive of the US dollar against certain currencies, specifically the euro, the Swiss franc, the British pound, but it doesn't necessarily mean that it's going to be positive against the Aussie, the New Zealand, or even the Japanese yen, which we'll talk about here. Now, when we look at the dollar index starting the week, we are up against a very significant trend line here. So this trend line must break in order for the dollar to move higher against the listed currencies. Now, our key VantagePoint level comes in at 95.61. We've closed at 96.32, which is very good. Above this we're long, below this we're short. But we must break through this identifiable level, of resistance, which is that trend line resistance. Now, our VantagePoint indicators are moving sideways here, which is a bit of a concern. Our strength indicator, predicted short, medium, and long-term differences are moving sideways, but they're recovering here. They're holding above the zero line. The position of the predicted MACD and the position of the predicted RSI at 67.2 is supportive of the dollar rally here. Now, again, that doesn't mean that the dollar will just rally across the board. They will be very selective rallies. Now, I would look for these indicators from VantagePoint to turn back up. Our neural index looks good, but I need those shorter term indicators showing some strength above this area so we can break through this trend line. So it is going to be tricky, but if the dollar fails, we understand why, because we're drawing in our proper levels of resistance here and we're matching it to the VantagePoint indicators. So right now the dollar does carry a bullish tone against the euro, against the Swiss franc, and definitely against the British pound. So when we look at our support levels here, we've got our key VantagePoint support level 95.61. That would then be followed by this lower trend line area. We can see price action is rising. We're at 93.50 on our lower trend line, which again supports those dollar longs for at least the near term. Now, in most cases, the dollar will rally with the S&P 500. We can see the S&P continues to push higher here, but this is a known area. We've known this area for the last year. Only a sustained break of that 2130, 2150 area that I've talked about in the last several Forex weekly outlooks would see a significant move up on the S&P. So my optimism on that continues to remain heavily guarded because we're going into summer trading. Normally the S&P does not do that great going into July, August, and September. Case in point, if we look at this 1 year ago, we're basically exactly where we were 1 year ago, and you can see that we went sideways and then ultimately we went down. Then we started to recover. Back into September there was a bit of a recovery there, but it really never regained those high levels in the better part of in the better part of 2016. So we've had this rally that started in February. We've been going up ever since then, and then this rally absolutely looks tired here, guys. So if we can push above 2150 or at the very least 2140, then we could see further gains in the equity markets. But Case in point here, I think, is looking at the global equities in general. When we look at the DAX 30, we're not seeing those kind of gains in the European equities, and more importantly on the Nikkei, we are not seeing those gains either. Now, in many of my presentations, I've put the global equities up against the S&P 500, and I've shown basically there's about a 90% correlation to the global equity market. So if the S&P 500 is the only one that's going higher, then that does not actually bode well for the global equity situation here. So the S&P, the Nikkei, they usually all go up or down together. So either the Nikkei and the DAX are going to turn around, or the S&P is actually getting ready to fall. Now, when we look at intermarket correlations, one of the leading indicators here would be, of course, oil to the equity markets. We can see we have a trend line break. We have a retest here of the key VantagePoint 18-day predicted moving average, which comes in at 48.40, and then we have failed. We have had a significant failure off of this bar right here, which is Thursday's bar, a drop of some 5% based around the VantagePoint forecast of the triple EMA cross, the retest of the 18-day predicted EMA at, again, 48.40, only for the market based around that forecast to drop significantly. So for the trader who knows these levels, very good opportunity this past week shorting oil contracts based around the VantagePoint forecast. Our neural index here gave us a significant warning days ahead of time that this was getting ready to happen, and we're simply looking for a retracement, which again has absolutely nothing to do with Fibonacci or Elliott wave or any of this stuff. It has to do more with the correlation to 30 other markets that forecasted that oil was going to drop again. So a lot of people were getting quite bullish on oil, and they probably got caught long. But again, there was no buy signal here from VantagePoint in any of these indicators. Our predicted MACD crossing the zero line, that break of the 40 level of the predicted RSI led to a significant move. Now, are we getting moderately oversold here? Moderately, yes. Not excessively oversold. So this would suggest that oil is going to struggle, continue to struggle next week. But if the equity markets, if the DAX turns around, the Nikkei turns around, and the S&P keeps moving higher, that may indirectly give oil a boost. But we have been down in this area for a very, very long time on oil here, guys. When we look at this over the last year, this looks like nothing more than a retracement in the broader downtrend. Now, does that mean we're heading back to $35 a barrel anytime soon? Not necessarily, not during summer driving season, but it still points to considerable weakness when we see this 1 year ago on the oil contracts here. Again, another very good call from VantagePoint at that level. We basically more or less a cliffhanger, a few minor retracements here, but ultimately we just kept going down and down and down. So now, yes, we are starting to move higher, but there are certainly no significant new highs in oil, and I don't see that happening anytime soon. In most cases, oil starts to weaken towards the end of July and August as summer driving season wraps up. Now, as we again coming into gold this week, gold is going to continue to have support as long as those equities are moving lower, the global equity markets. Now, will that payroll number be enough to knock the wind out of gold? I think gold right now is up some 27% on the year, silver even higher than that. So right now, the key VantagePoint level, 1320, we've closed at 1358. 1320 is likely to come under significant pressure here this week based around that stronger labor report, the stronger U6 number, the overall improvement. Does that mean the Fed's going to hike? That's anybody's guess what the Fed is going to do. I don't see them hiking until the fall. Maybe even the fourth quarter. We'll have to see on that one. But for now, based around that, the global situation, global economic situation, it is indirectly supporting gold. Would gold be at this level if it wasn't for the Brexit? Probably not. Gold was already making gains, but we've had significant gains from this 1240 mark based around the Brexit. Now, once everybody starts getting more comfortable with this, and we can see this is the bar here from the Brexit vote where gold took on a substantial amount of gains. Have we made any real progress on gold since then? Not a lot here, guys. We've had a big move up. We've leveled off. We've started to move back up again. But that payroll number may be a little bit too much for gold for the next couple of weeks, and we're probably going to see a significant corrective move lower. Now, as we come into our Forex pairs, and again, the euro in most cases has a very high correlation to gold. So if gold is moving lower, in most cases, the euro is going to be moving lower. So right now, again, that key vantage point level that we want to look at, that 18-day predicted moving average, we can see we have had multiple retests of this area this past week, only to be met with sellers. So as long as we're holding below 111.39, shorts for next week clearly favored. And again, we look at our short, medium, and long-term predicted differences with our neural index. Again, our predicted MACD. And what I really like here is a break of the predicted RSI, 31.8. When most people are looking to buy, we're actually looking to sell because we're looking at momentum now. Case in point here on the VantagePoint predicted RSI, we can see it here when we've hit a swing high, and then the break of the RSI we can see led to a significant downward move here from the 116 area all the way down to the 111, some 400 pips. Now, this is where the advantage of, most people are using RSI, stochastic, all of these different indicators for overbought, oversold. I actually don't necessarily recommend that in most cases. I'm looking to go with the market. An RSI, predicted RSI, is a leading indicator. So it's, leading indicators, yes, they can give some false signals, but usually when they're matched with a swing high, a swing low, and a trend line, then they are very, very useful. It is a very useful indicator. So this would show me that Euro US likely is going to come under selling pressure to start the week, probably until Wednesday or Thursday. Then we could see a moderate turnaround. So if Euro US is going lower, then in most cases US Swiss franc is moving higher. I've been buying this one all week with my own direct clients. We can see we've had a 3-day test of this key vantage point level, which now comes in at 97.32. That's our 18-day predicted EMA. We've closed at 98.29. Everything looks good here. Our indicators are a little bit flat here. The predicted short, medium, and long-term differences are how VantagePoint gauges the strength. Also very effective for overbought and oversold conditions. So we're starting to move higher. The position of the predicted MACD taking over that zero line, I really like the look of that. We can see, again, case in point, we look for repetitive moves here. When we match that to a VantagePoint triple EMA cross, that led to a significant rally from 97 all the way to 99.50. So that same signal actually presents itself right now. So we would look to basically buy on dips down to 97.30. So we've got 97.93, 97.62, and again 97.32, the key vantage point level. These are our pivot levels of support. Now we also have a trend line break, which is again supportive of further longs here. That trend line break comes in at 98. So we're going to look for 98, maybe just below that 98 level in this clustered area between 97.62 and 97.93 to start our longs to begin the week. And I think they are viable long trades based around that employment report. Now, as we come into the British pound US dollar, we have had follow through on this. Again, we have to be very, very cautious with this pair. Is this a potential swing low that's going to pause here? I don't think so. Our key vantage point level 135.32, 131.48, and 129.47. We're still closing below all three of the key vantage point levels here, highlighting that. So that is overall still bearish. Is this potentially a base here for the British pound? Well, that's very difficult at this time to say. We've got our additional indicators from VantagePoint that are starting to rise higher, saying we are moving into oversold. Our RSI has been completely flat for some time, but the market is still pushing lower. So until we find some sort of solid base here, believe it or not, shorts are still appear to be the best play here. Myself, with my own direct clients, I tend to advise them to just just stay clear of the British pound right now. It's too choppy. But again, we still are looking for a base here. We've made a new low on the week again here. And unless we get a sustained break of 135.32 or the VantagePoint 18-day predicted EMA, then we would be sellers into any kind of rally on this particular pair. But I believe it does need to have a significant corrective bounce higher before I start looking at getting short on this. Now, the dollar yen, again, with the dollar yen, I've got a little bit different setup to point out to everybody here this week. You can see that I'm taking a swing high and a swing low off of the Brexit vote. This is a great big move up and a great big move down after the Brexit vote. So we're still trapped inside this, guys, but nothing has changed. As I talked about in last week's Forex Weekly Outlook, only a sustained break of 103 would see us getting long on the dollar yen. Now, could the dollar yen recoup this week based around that unemployment report? Yes, it's very possible that if it has a positive reaction, that people start coming out of the Japanese yen and going into the Nikkei. That's how Forex works here, or trading in general, is money is either going into the yen or it's going into the Japanese stock market, which is, of course, the Nikkei. That hasn't happened here yet. Money is still going out of the Japanese stocks and into the yen. So until that changes, we still have further, I believe we still have further downside. That key vantage point level, we'll talk about it again here. We're closing out at 100.49 in most cases. Now, not in all cases, but in most cases, whatever happened on Friday on the non-farm payroll, the exact opposite happens on Monday, regardless of the numbers. So the dollar yen sold off based on a pretty solid jobs report in my respectful opinion. Not great, but solid enough. Again, basing my argument around that U6 number, the average hourly earnings, there's a bunch of components in there, but in general, it was better. So the dollar yen should base out here. We've got this area down around 98.50, which is the bottom of this range. So I'm not drawing trend lines in here. I know where my key vantage point level is. I know where my swing highs and swing lows are from the Brexit. I'm looking for the lower end of this spectrum to hold. Will it? That's left to be seen. If those equity markets, if the S&P 500 follows the DAX and the Nikkei lower, then the dollar yen goes lower, guys. This is an equity-based trade. So if the global equities are turning negative, money is absolutely going into the Japanese yen. So the key level again to watch, basically with this one, we're short below 103.12. Now, as we come into our commodity currencies here, we've been here before on USCAD, and we can see our trend line. We're back up here testing this trend line. And again, we've got our swing lows where we draw our trend line in. I'll just draw this so everybody can see it. Key vantage point level this week, excuse me, I'm just going to draw that. Let me erase that there. Okay. So our key level here, 129.32. Now we've had a bunch of tests here. This trend line, actually, we're just going to switch this here so everybody can see it. I'm going to delete this and redraw our trend line in here. So we have basically a new trend line that is formed here, and I'll just bring that back up so everybody can see it again. It's important to always update your levels and draw your trend lines from right to left, never from left to right. So we want to make sure that we're basing our trend lines on current price. When I look at this, the 129.32 is basically now we've got an intersect here with the 129 level on the trend line and the key vantage point 18-day predicted EMA. So long while above this, guys. This is the key thing. But we need to break this area. We need to break through this swing high, and we need to break through the original swing high that dates back to basically May 2016. So if we can push through this area up here, then we got a shot at getting back to 132. What are we going to need for that, guys? We're going to need lower oil prices. We're going to need equities moving lower, a risk-off environment, which will weaken the CAD dollar and push this pair higher. So are our indicators supporting that right now? They actually are. The predicted short, medium, and long-term differences, the position of the predicted MACD, and the position of the predicted RSI at 61.6. This points towards momentum building to the upside. But we must break through 131. We must close above 131 and stay above this level if we have any shot at taking out 132, 133, or returning back to the 134, 135 area. Okay, so it's going to be a tricky play here, but know your levels. So what you really want to watch this week is a sustained break of this level right here, 131, 131.10, but a lot of staggered resistance all the way up to 131.80. And that's what I'm saying. Once we break free and clear of 131, get above 132, then we should start to see a move higher here, but that's not going to happen overnight. So the indicators from VantagePoint are clearly telling us to stay long while above 129.32. Now, the Aussie currency, now this is another tricky one this week. Our friends at Standard & Poor's basically did a credit downgrade, still triple grade A credit, you know, for the Aussie, but they went from stable to negative. Now, what I want to point out here, guys, Standard & Poor's, these are the wonderful people that directly were partly responsible for the financial crisis of 2008. So if they're downgrading, if they're saying their credit's no good, then with these people, up is down, down is up. So I would be inclined to disregard that. Based at looking at the economic basis of Australia, they're still doing quite well. So of course the Aussie sold off Thursday night based around that report from Standard & Poor's, the S&P, doing that slight credit downgrade, but they still have an excellent credit rating. Their economy is doing very well. So again, looking at the history of some of these credit rating agencies after 2008, you can see probably why I don't really pay too much attention to what these people say. You know, I look at the economy in Australia, I look at who they're tied to, what they're tied to. Things look still pretty good there. Buying Aussie, still a reasonable play here. Very reasonable play here, guys. Why we hold above 74.69. Even with that good labor report, we still closed at 75.63. Could it come under selling pressure? If it does, it's going to be on this trend line at the 76.50 area here. Our indicators from VantagePoint are saying we probably have more upside. We're holding above the zero line on the predicted MACD. We're at 70.5. It's possible we could have a failure on this trend line. What's it going to take, guys? It's going to take those equities moving lower. Risk-off environment will send the Aussie lower. Right now, it appears that we're back to a risk-on as the S&P approaches back up to the 2120 level. So this is indirectly supporting the Aussie currency, but again, little bump in the road against some of the Euro against some of the Aussie cross pairs. But even those cross pairs, I would look for them to recover here. Is again an overreaction to Standard & Poor's credit downgrade from stable to negative. They could turn around and say the exact opposite 3 months from now, and probably will. And again, you know, I can't stress, you know, the credibility of these credit rating agencies certainly carries no weight for me after 2008. Have they fixed anything in their systems since 2008? Of course not. It's probably worse, if anything. So we want to keep that in mind when we're looking at certain fundamentals. Now, what I will point out here too with the Aussie is we had a couple of really nice bounces here off of that 18-day predicted EMA. So even though after that credit downgrade we came down, we tested that 18-day predicted EMA, lots of buyers coming in. The same thing here happened again on Friday after the nonfarm payroll. So once again, as long as we hold above 74.69, that key VantagePoint 18-day predicted EMA, the long side does still carry some weight at the end of the day. So we'll continue to monitor that downside action for buying opportunities. Right now, the same would apply for New Zealand, basically the same pair, Aussie, US, New Zealand, US, where you can see that we're running right along this trend line here. We've had multiple retests of this area and the 18-day, most recently a test this past week of the VantagePoint 18-day predicted EMA at 71.29, and buyers coming in without question off of this area here. So as long as we hold 71.29, then longs carry the edge, buying down to this lower trend line, and that matches the VantagePoint 18-day predicted EMA is a reasonable play. Our additional indicators from VantagePoint, the predicted differences, the neural index, our predicted MACD crossing back to the upside, our predicted RSI 71.5. I think we've got a little bit more room to run, but I would suspect that we're going to have a pullback here, which will be an equity driven trade. So if the S&P, if I'm correct, and the S&P starts to see sellers coming back in, that would drive the Aussie and the New Zealand lower, and the CAD for that matter. So these are the things we have to look for in our trading week. We have another busy week coming up next week. We are in summer trade. We're going to see sideways markets here, but there should still be some very good trading opportunity.